Hi everyone. Today in this webinar, we are going to share a little bit of the updates on the COVID-19 government support packages from Singapore. And this update is as at 1st April 2020. The agenda for today, we will share a brief overview of the impact of COVID-19 on the Singapore economy, followed by some of the key measures that can help businesses and households, and also some of the grants that can help these businesses to build capabilities. So we start off first with the impact on the Singapore economy. As we all already know, the Singapore economy has contracted significantly by 2.2% year-on-year in the first quarter and shrank by 10.6% on a quarter-to-quarter annualized basis. And 2020's forecast is downgraded to now a range from -1% to -4%. So as I believe we all know, this is mainly due to the fact that there is lesser spending now. As we all know, most of us are working from home currently, and also the reduced demand as well as the disruptions from supply chains worldwide. So from the chart here, you'll be able to see that Singapore's historical GDP growth and past recessions. During SARS, and also the 2009 global financial crisis, Singapore is still able to post a GDP growth of 4.5% and 0.1% respectively, despite the recession. So this could well be one of the reasons why a lot of us are now feeling or experiencing the impact of COVID-19's outbreak on economy as well as on our individual side. And so recently, the government has announced two budgets. First is the Unity budget of 6.4 billion, which was announced in February 2020, as well as a supplementary resilience budget of 48 billion that was announced in March 2020. So a total of 55 billion has been allocated and set aside for to help businesses and also households in Singapore to tide over this crisis. So how is this 55 billion funded? A big portion of it comes from our current reserves, and 17 billion is going to come from the past reserves. So as we all know, just a point to note, the last time Singapore drew from the reserves was a amount of 4.9 billion during the global financial crisis in 2009. So basically, we didn't even drew any of the reserves during SARS. So it sort of shows how bad the impact COVID-19 has on our economy. So now we move on to some of the key measures. One of the first key measure is to provide immediate cash support for companies. So to address companies' short-term liquidity needs, there are two loans available currently. First is the temporary bridging loan scheme. This loan allows companies to loan up to $5 million with the fixed interest rate capped at 5% per annum. And the other loan available is the SME working capital loan. So this has been further enhanced where companies can now loan up to $1 million. And for this, there is no change to the interest rates. So for both loans, the government is doing a risk share of 80%, and the maximum repayment period is 5 years. For the TBLS, the eligibility of this loan is for Singaporeans and PRs who owns 30% of the equity shareholdings, whereas for the working capital loan, there are, other than this criteria, there is also the criteria of having the group revenue up to $100 million or maximum employment of 200 employees. So how do companies who are interested apply? They have to approach to the list of participating financial institutions to apply for either of the loans. And the availability of these loans is for a period of 1 year from March 2020 to March 2021. So companies now have the options to also apply to the PFIs for a 1-year deferment of the principal repayment so as to better manage their debts and their short-term cash flows. So from a summary of these two schemes, there are some key pointers that we would like our clients to take note of. Under the working capital loan, I believe some of the clients are already on the working capital loan. So at this point in time, if they do need short-term cash, they should call up their bankers right now and to check with them to get them to do a reassessment of the credit lines now that the quantum of the loan can go up to $1 million. It might help. And for companies, they can actually apply for both loans. So when deciding which loan to apply, they might want to consider the interest rates. So with the TBLS interest rate capped at 5% per annum, we would encourage clients to take up to look at the bridging loan first before looking at the working capital loan, because with this cap, the effective interest rate under the bridging loan scheme will be lower. Also, another key point to note for taking up the loan is that even though there is this option for SMEs and companies to apply for the 1-year deferment, companies need to think carefully about this, because by deferring this principal repayment, it also means that it prolongs the future obligations that they have. So before making any decision, this is one of the key considerations that they have to take note of. So other than the two loans, MAS is also working with all the FIs to support SMEs with the continued access to bank credit and insurance cover. So 3 of the points here are: first is on the deferring payment of the principal on secured SME loans. So again, as I mentioned earlier, SMEs can now apply to defer their principal repayments on their secured term loans until the end of the year. However, the interest remains payable, and this includes the additional interest that is accrued on the deferred principal amount. The loan term can be extended up to the corresponding principal deferment period, and the only criteria here is that the borrower must not be more than 90 days past due on loan repayments as at 6 April 2020. Banks and finance companies can also now apply to MAS for funding of new loans. So any savings out of this funding costs are to be passed down to the SMEs. This is the only criteria for this MAS funding. Lastly, they can also apply to insurers for installment payment plans so as to better manage their short-term cash flows. Next, we move on to the measures available to help save jobs for companies and their employees. So before we move to the two main schemes, I would like to run through some of the guidelines from National Wage Council. So under National Wage Council guidelines, to save jobs, the employers are encouraged to consider the following in order of priority. So of course, the first is to reduce non-wage costs and to manage the excess manpower, and then to tap on the government support and to press on with business and workforce transformation. Next is to think of trimming the wage costs. And lastly, when points 1, 2, 3 fails, and the company still has to retrench workers as a last resort, they have to make sure that it is done in a responsible manner. On Guideline 1, NWC encourages companies to focus on the training and upskilling, and as well as adopting flexible work hours for their employees. And also in the current climate, many employers are now implementing job sharing arrangements, shorter work week, or temporary layoffs. So NWC is suggesting that employers should also support these affected workers who wish to seek a second job or temporary or part-time work to supplement their income. Guideline 2 seeks to get employers to bring forward training programs for their employees whether is it to upgrade their current skill set or to train them in emerging skill sets such that they will continue to remain employable. Companies can also consider setting up company training committees that will help employers build in-house workplace learning capabilities, conduct ops tech road mapping, and also re-strategize their businesses. And also, they can also try and share productivity gains with their employees, and such that they can benefit from the enhanced wage credit scheme, which I'll talk about more in detail in the later slides. On the trimming of wages, for employees who are adversely impacted by COVID, they should think of reducing wages with the management leading by example. And when reducing wages, they need to think and take into consideration workers who might take a stronger impact because they are earning commission-based variable payments, taking overtime pay, or being asked to take a no-pay leave. So in such cases, when doing a wage reduction, management should try and moderate the impact of this reduction on them. Companies on the monthly variable wage component program should also consider adjusting this if they feel that the monthly wages are unsustainable. Companies are also encouraged to continue to pay AWS, and also when applying the wage reduction to employees, whether it's local or foreigners, they need to apply it fairly. For employers who are doing well, they should consider to reward workers with variable payments, and also to build in wage increases if they feel that the business is facing future uncertainties in this climate. Last, they should also soften the impact for low-wage workers. So for workers who are earning a basic monthly wage of up to 1,400, companies should consider freezing their wage if the policy of the company is to reduce the wages. And they should build in wage increase if their policy is to freeze or to increase the wages. Also, for workers who step up during this challenging period to help the company, companies should also consider rewarding them with ex gratia payments. Lastly, on retrenching responsibly, employers should be able to select employees on a fair and objective basis, and they should inform MOM and consult unions if it is unionized. Longer notice periods should be provided, and retrenchment benefits should be provided in line with the tripartite advisory on the MOM website. Employers, when possible, should also help these employees to look for jobs. So we now look at the first support scheme, which is the job support scheme. JSS provides up to 25% cash grant on the gross monthly wage with a cap of 4,600 for each local employee. So in order to qualify for this, there is no need to do anything because this is automatically calculated with our CPF records, and it is administered by IRAS. So JSS has been enhanced in the resilience budget to be paid out in 3 tranches. So from the table here, you'll be able to see that the first tranche with the qualifying period of October to December 19 would have been calculated, and the payout is to be done in 2 months' time in end May 20. The next 2 payouts will be one will be done in July as well as October 20. Some of the sectors that are more badly affected will get a higher cash grant support. So like things like aviation and tourism sector, they will get up to 75% of their wages supported. And for food services, they will get 50% of their wages supported. Next is the wage credit scheme. So there is an increase in the co-funding level to 20% and 15% for 2019 and 2020. And the gross monthly wage ceiling has been increased from $4,000 to $5,000. Again, there is no need for companies to do anything so long as they meet the 3 requirements listed here. It is automatically calculated with our CPF records and administered by IRAS, same as the JSS. So the payout dates are usually payout dates for this scheme is on the 31st March of every year. So for FY19, I believe the payout would have been done on 31st March 2020. So the next payout, which for FY 2020 has been brought forward as announced in the resilience budget to 30th June 2020. So what does this mean? In this next example, you will see that under the 2019 column, before there was the enhanced wage credit scheme, the co-funding from the government is 15%. So the 15% would be paid out on 31st March as how it was originally structured. So now with the enhanced wage credit scheme, there are companies will then receive an additional 5% in 2019. So this additional 5% will be paid out earlier in June 2020. As for FY 2020, originally the co-funding was 15%, was 10%, sorry. So now it has been increased to 15%. And it will be paid out as usual in March 2021. Next, we move on to some of the measures that can help enterprises to reduce costs and cash outflows. So income taxes. Companies are now entitled to corporate income tax rebate of 25% of tax payable, capped at 15,000 for YA 2020. They are also entitled to this income tax deferment for FY 2019. So tax payments are automatically deferred for 3 months. So tax payments that are due in April to June 2020, the collection will be done in July to September 2020. For this rebate and deferment and tax referment is automatically calculated based on our income tax return. So companies need not do anything further. There is also an accelerated capital allowance, allowing companies to now carry back losses up to 3 immediate preceding YA. There is also the option to accelerate the write-off of plant and machinery purchase costs over 2 years, and also the option to accelerate deduction of expenses on renovation and refurbishment in 1 year. So for companies who are badly affected, they can also require for additional help by speaking to IRA's officers, who will then be able to help them assess the situation on a case-by-case basis. Property tax rebates. For the aviation and tourism sectors, property tax rebates of 100% will be given. And for integrated resorts like MBS and RWS, the property tax rebate of 60% is given. And in a recently announced resilience budget, there is an additional 30% given to non-residential properties like offices and industrial properties. So we strongly urge our clients to speak directly with your landlord to ask for a rental discount. There are also rental waivers on the government properties given. So up to 3 months waiver is given to hawker centers and markets. Up to 2 months are given to commercial tenants. And the new half-month waiver is also given to all other non-residential tenants. So for companies that requires additional help, probably they need more than 3 months of waiver, they can speak to the relevant government authorities so that these authorities can help to assess the situation on a case-by-case basis and provide help as and when needed. All government charges and fees will also be frozen for a year from 1st April 2020 to 31st March 2021. And no application is required. There will no longer be fees or invoices from the Singapore government for this 1 year. Last, we touch a bit on some of the grants available to build capabilities. As we all know, a lot of us are now working from home, so a lot of us are using digital solutions, like for example, Zoom meetings, instead of having face-to-face conversations with our clients. So a lot of these grants listed in the next few slides are aimed on all the digitized solutions that companies can tap on. The first would be the Productivity Solutions Grant. This grant encourages enterprises to continue with digitization and productivity upgrading. It provides a maximum funding support of 80%. This was raised from the previous 70% and is for the period from 1st April 2020 to 31st December 2020. This grant is provided on a reimbursement basis, which also means that companies with this grant would have to fork out 100% of the expenses first before they can claim 80% from the government. An enhancement to the Productivity Solutions grant is that there is also the increased scope of generic solutions to this 4 tools, systems, and solutions, which includes, like I mentioned, some of the Zoom and webinars that we're using. So what do we encourage our clients to do? For existing PSG vendors, meaning clients who are already on the grant, they can speak directly to ESG so that they can now be included in this increased scope of generic solutions so as to benefit from the enhanced funding. And for new users, if you require any of this funding support, you can now apply directly to ESG for the grant from 1st April 2020 onwards. So under the Productivity Solution grant, there is also this SME Go Digital Programme, which aims to make it easy for SMEs to adopt digital solutions. So interested SMEs can apply under the productivity, the PSG, which provides up to 70% grant support on the cost of adopting these digital solutions. So in the chart here, you would be able to see how SMEs can actually get started with this program. So for existing SMEs, they can actually approach the SME Center for advice. So if it's something that is very basic, they can identify their needs through the industry digital plans. So industry digital plans are pre-approved solutions that are applied to specific sectors. So for SMEs with basic needs, they can choose from these pre-approved solutions and apply for PSG. Whereas for SMEs with more advanced needs, they can reach out to the SME Digital Tech Hub, where there will be experts who will be able to provide further assistance to help them adopt their digital solutions. As for newly incorporated SMEs, they can approach the Start Digital partners who, where they can take up Start Digital packs for foundational solutions. I will explain this Start Digital pack shortly in the next slide. So what are Start Digital packs? It helps newly incorporated SMEs to get started. And it's offered by banks and telco partners as listed here. So SMEs will be happy to know that if they sign up for a minimum 18-month contract, they will receive cost waivers for at least 6 months, applicable for any 2 solutions. So under this SME Go Digital program, there is also a new launch of this Go Digital, which supports SMEs who are willing and ready to venture to overseas markets. And they will then have access to established B2C and B2B e-commerce platforms. They are pre-approved by IMDA with some of these listed benefits. Also, they will be able to receive training and support to build their competency for cross-border e-commerce. So this is a newly launched program. So more details will be announced in Q2 2020, and we will provide updates, further updates when we receive the announcement. Next is the Enterprise Development Grant, EDG. So EDG helps companies to grow and to transform. So it provides funding support up to 80% for the period of 1st April to 31st December 2020. Previously, this was 70%. And enterprises who are badly impacted by COVID-19, you will be pleased to know that the maximum support level can be raised to 90% on a case-by-case basis. So for any companies who currently have specific projects that fall within the scope of the grant, which you will be able to see the list in the ESG website. I encourage you to quickly speak to ESG and see how they can work with you to provide the maximum support for your projects. And under EDG, there is also this automation support package, which supports the company's usage of automation and technology. So the EDG support is for qualifying project costs such as equipment, training, and consultancy. So for SMEs, they will provide up to 50% of qualified software and equipment costs, and up to 70% for all other qualified costs. And for non-SMEs, it is up to 30% for qualified software and equipment costs, and up to 50% for all other qualified costs. 100% investment allowance is also provided for automation equipment, and such automation equipment can borrow up to 15 million loan. The scope would be on the adoption and development of sophisticated hardware or software solutions, and also solutions that involve purchase of machinery and integration of systems, and training of staff to deploy these solutions. So again, if the company has any of such qualifying project costs, we encourage you to submit your application to ESG under the EDG grant, under the Innovation and Productivity category. Next is the Market Readiness Assistance Grant, MRA grant. This helps SMEs to assess overseas opportunities, and it supports up to 70% of the eligible costs, and is extended 3 more years to March 2023. The grant cap is increased from 20,000 per year to 100,000 per new market over 3 years. And this can be applied through the business grant portal. Last but not least is this SkillsFuture Enterprise Credit, the SFEC, which encourages employers to invest in enterprise transformation and capabilities of their employees. So employers will now receive a one-off $10,000 credit to cover up to 90% of out-of-pocket expenses. Of this 10,000, they can only use up to 7,000 for enterprise transformation, and the remaining 3,000 would have to be used for workforce transformation programs. There is no cap on the amount used for workforce transformation, basically because the government wants to encourage companies to build and improve and to train their employees on their existing and future skill sets. And this SFEC can be used on top of the support levels of existing schemes. So basically this means you get double support. And I can give you an example in the next slide. So over here, you will see that these are the list of programs under the SFEC. So you will see some names that I've mentioned earlier in the slides. There's the EDG, there is the MRA, there is PSG. So take PSG for example. If you have a PSG project that is valued at 200,000, the PSG support up to 80%. So basically it's 160,000. And on top of this 80% support, you can utilize SFEC's support, which is capped at 7,000. So the net cost for the company would then, for this particular project, would then be $33,000. So that's all I have for this webinar on the COVID-19 government support packages update. We will continue to keep updating this with as and when there are new measures that comes up from the government. So we'll see you next time when there are further updates. Thank you.